Let's go through what's unfolding right now in the silver market and what these major voices are saying. Post by James Henry. Silver squeeze, pull below. London currently caught short 1,000-ounce bars. This is massive. According to James Henry, London is reportedly caught short on the 1,000-ounce silver bars that are the standard for institutional delivery. That means there's potentially not enough physical silver available to meet current demand, a situation that could trigger even more volatility and price spikes if buyers start demanding real metal instead of paper contracts. Post by Rashad Hayev. Silver as well could dip slightly under $49, but I expect buyers to step in immediately. My next silver target is $55 to $57 within the next week or two. This post is not an investment advice. It's simply his market opinion based on what he's observing right now. Rashad expects only a small dip below $49, but sees that as a short-term move before another surge. He's projecting a target between $55 and $57 in the coming 1 to 2 weeks, suggesting very strong momentum in the silver market. And as he clearly states, this is not investment advice. It's simply his market opinion based on what he's observing right now. Post by mining.com. The London silver market has been thrown into turmoil by a massive short squeeze, driving prices above $50 an ounce for only the second time in history. Mining.com confirms that the London silver market is under serious stress, describing it as a massive short squeeze. This means traders who were betting against silver are now being forced to buy it back at higher prices, pushing the price even higher. Crossing $50 an ounce for only the second time in history shows how extraordinary this move really is. Post by Echo X. If you aren't bullish on silver, I don't know what to tell you. Echo X captures the overall sentiment among traders, extreme optimism, or what some call silver fever. When you have supply issues, a short squeeze, and record-breaking demand, many investors naturally turn bullish. But as always, these kinds of markets can move very fast, both up and down. Post by Chris Marcus. And now the silver starting to get shipped back to London after the LBMA got its teeth kicked in this week. Chris Marcus points out something very interesting. Reports that physical silver is being shipped back to London after what he describes as the LBMA getting its teeth kicked in. In other words, the London Bullion Market Association may have been caught off guard by how quickly this silver squeeze developed, forcing them to cover physical delivery commitments. That's another sign that this isn't just a price story, it's a liquidity story. Post by Steve Hankey. Silver is screaming. It's up over 60% year to date. The market is sending a message loud and clear. Gold is insurance. Silver is the alarm bell. Steve Hankey sums it up perfectly. Silver has surged more than 60% year to date. He calls gold insurance, but silver the alarm bell. That means silver often signals when there's deeper stress building in the financial system. It reacts faster and more violently when confidence starts to shake. And right now, that's exactly what we're seeing. So, in summary, London is reportedly short on physical silver. Traders are being squeezed, and silver has once again broken above the $50 level. It's a moment of real tension in the global metals market, and all eyes are now on how the LBMA and COMEX respond in the coming days.
Let's start with what Kitco is reporting. Their article titled, "History Shows Silver Market May Now Be in Trouble," reminds us that whenever silver rallies too far too fast, it often ends in stress or sharp reversals. Analyst Jim Wyckoff points out that today's setup looks eerily similar to past blow-off phases: massive speculative inflows, tightening inventories, and extreme volatility. History, he says, has a habit of repeating itself. But there's a difference this time. This rally isn't only fueled by traders chasing momentum. It's also about a real shortage in available physical metal, the kind of shortage that even high-frequency trading can't paper over. Now, here's where Bloomberg's investigation adds real weight. Their report, Silver Squeeze Evokes Hunt Brothers as Banks Rush Bars to London, describes banks and refiners literally rushing to get 1,000-ounce bars flown into London vaults. Why? Because there's not enough silver available to meet delivery commitments. In the LBMA system, most silver is traded as unallocated, meaning the buyer doesn't actually own specific bars. But when too many people demand physical delivery at once, that system strains. And right now, that's exactly what's happening. Sources told Bloomberg that spreads have widened, borrowing silver has become extremely expensive, and some traders are panicking to cover positions. It's the classic setup for a squeeze, except this time it's global. This echoes the late 1970s, when the Hunt brothers famously tried to corner the market by buying up massive amounts of physical silver. Back then, exchanges intervened, raising margin requirements and crashing the price overnight. But this isn't 1980 anymore. The LBMA isn't being cornered by two billionaire brothers, it's being cornered by reality. Years of undersupply, industrial demand from solar and EV sectors, and the growing preference for real metal over paper contracts. So, while the Kitco analysis warns that the market may be in trouble, Bloomberg's reporting suggests that the real trouble might be on the institutional side. For those who owe silver, they can't easily deliver. Let's look deeper at why the LBMA is under such strain. First, vault inventories have been falling for years. Second, the amount of silver held in ETFs and private vaults that's silver effectively taken off the market has surged. Third, many refineries and mints are operating near capacity. They simply can't produce or ship bars fast enough to meet demand. When physical supply tightens like this, the entire paper side of the market becomes fragile. That's why we're seeing what Bloomberg calls banks rushing bars to London. It's not a metaphor, it's literally happening. So where does that leave investors and everyday people watching this unfold? The short answer, at a crossroads. If history repeats, silver could see sharp corrections, just as Kitco warns. But if this is more than just a speculative blow-off, and instead the early stage of a structural supply crisis, the price of silver could redefine what expensive even means. Because when a market built on promises meets the hard limit of physical reality, it's the real metal that wins. The truth is, no one knows exactly how this ends. But what's clear is that confidence in the paper-silver system, and perhaps even the LBMA's foundation, is being tested in real time. As investors demand delivery and the flow of bars tightens, the world is discovering what happens when just-in-time meets nothing left. History shows silver crises always teach the same lesson. You can't print metal. This is not financial advice, it's information and commentary based on reports from Bloomberg and Kitco. Always do your own research, and remember, volatility cuts both ways.